Hello there. Welcome to video 122 from Sumit Academy. I do hope that you have subscribed to my channel. Do subscribe now so that you do not miss out on my previous or future videos. And do remember to like and share this video. To make your task a little easier, here is a complete list of all videos available on my YouTube channel. The list is divided into the playlists under which they are available. Do have a look. In this video, we shall talk about individual credit score and how it is different from credit rating. Do see my earlier video on sovereign credit rating also. If we talk about an ideal world, everyone would have enough money to take care of their needs. However, most of us have little option but to take credit to meet our life goals, especially the ones involving a huge amount, like buying a car or a home. To ensure that the bank is willing to lend money to you, it is important to have a good credit history, which is determined by not only the credit score but also the credit rating. Credit rating is thus an assessment of the borrower that determines whether the borrower will be able to pay the loan back on time as per the loan agreement. A good credit rating depicts a good history of paying loans on time in the past. A credit rating, often expressed as a letter grade, conveys the creditworthiness of a business or a government. A credit score, usually given as a number, is also an expression of creditworthiness that can be used for businesses or individual consumers. This number can be in between 300 and 900. Credit report plays an important role in loan and credit card approval process. Now, you may have heard of the term CIBIL score. Well, Credit Information Bureau India Limited, commonly known as CIBIL, is India's first credit information company or credit bureau. It maintains records of all credit related activity of individuals and companies, including loans and credit cards. The records are submitted to CIBIL by registered member banks and other financial institutions on a periodic, usually monthly, basis. Based on this data, CIBIL issues a Credit Information Report or CIR, commonly referred to as a credit report, and a credit score. Now, just for your background information, CIBIL was founded in the year 2000 in order to bring greater efficiency and transparency in the credit space. TransUnion International, a global credit bureau, and Dun and Bradstreet, a global provider of credit information, are technical partners of CIBIL in India. CIBIL's mission is to catalyze growth of credit in India through solutions that enable well-informed credit decisions, technology that enables superior information availability, and people that provide high-quality services. It has an ISO 27001 rating, which is the highest security standard in the world. CIBIL has two focus areas, that is, a consumer bureau that deals with consumer credit records and a commercial bureau that deals with the records of companies and institutions. It is important to note that CIBIL is a database of credit information. It does not make any lending decisions. It provides data to banks and other lenders who use it as a quick and efficient resource to filter loan applications. Now, CIBIL is not the only one. A credit report is issued by 4 authorized credit bureaus in India. Now, these are CIBIL, Equifax, CRIF Highmark, and Experian. These credit bureaus collect and maintain records of the credit-related transactions of individuals as reported by their lenders. Now, these can be banks, non-banking financial companies, or credit card companies. This information could include details of all loan and credit card repayments, including any late or missed payments, details of inquiries made by lenders on loan or credit card applications made in the past, all current loans and credit cards, total credit limit, and other such credit related information. There are several reasons why the credit report is highly valued. It offers a single comprehensive report of the customer's past and current borrowing and repayment history, gives potential lenders a detailed idea of the customer's spending discipline and ability to fulfill debt obligations. gives individuals information on their credit strengths and weaknesses, and enables them to take focused steps to improve their credit health. It ensures greater transparency and streamlining in the loan approval process, as customers and lenders have access to the same credit information. Customers know the reasons why their loan has been rejected, and lenders can make quicker decisions on who they can lend to without spending time and money on background checks. In a typical credit report, you will see demographic and identification data on your credit report, like your date of birth, current and previous address, email ID, telephone number, PAN number, driver's license number, passport number, type of employment, and annual income. It is important to ensure that all this information is correct so that there are no administrative errors when you apply for a loan. It is also a good practice to check your credit report every year. If there are any errors, it is vital to coordinate with the lender and the credit bureau to resolve these immediately so that it does not impact your loan application. Next, you will also find details of every single loan that you have ever been granted. Your report will list the names of all your lenders, type of loan, personal loan, credit card, auto loan, etc. Date the loan was disbursed, total amount of the loan, the current outstanding, interest rate charged, the period of the loan, monthly EMI amount, current status of the loan, 36 months history on your repayment behavior, etc. Late payments, if any, are recorded as DPD or days past due. All overdue repayments are listed, and the status field will signify if there is any negative status. For example, if the loan is in a write-off status, previously settled, if a legal suit has been filed, or whether the loan is considered current, which means all repayments are being made in a timely manner. This is important data in the computation of the credit score, and you should ensure that this section is always and completely accurate. Lastly, the credit report will list the number of times that you have ever applied for a loan or credit card. That is called a credit inquiry. Too many credit inquiries without a corresponding approved loan could adversely affect your credit score. This means that the customer is credit hungry and could have a negative impact on your credit score. Now, the CIBIL score is a 3-digit numeric summary of your credit history. The score is derived using the credit history found in the CIBIL report. A CIR is an individual's credit payment history across loan types and credit institutions over a period of time. A CIR does not contain details of your savings, investments, or fixed deposits. It helps investors to recognize the risk involved in lending the money and gives a fair assessment of the borrower's credibility. No bank or money lending company would like to give money to a risky customer. With credit rating, they get an idea about the credit worthiness of an individual or company who is borrowing the money and the risk factor attached with them. By evaluating this, they can make a better investment decisions. High credit rating means an assurance about the safety of the money and that it will be paid back with interest on time. Let us see how credit ratings work in India. The major factors are credit history, credit type and duration, credit utilization, and credit exposure. Every month, these credit rating agencies collect credit information from partner banks and other financial institutions. Once the request for credit rating has been made, these agencies analyze the information and prepare a report based on such factors. Based on that report, they grade every individual or company and give them a credit rating. This rating is used by banks, financial institutions, and investors to make a decision of investing money, buying bonds, or giving loan or credit card. The better is the rating, more are the chances of getting money at payable interest rates. So, what does go into a good credit score? The first factor is your payment history. A history of late and missed payment lowers your credit score more than any other factor. The second factor is your credit utilization ratio. Your credit utilization ratio is the amount of credit you have used divided by your total available credit limit. Having a good credit score requires a credit utilization ratio of 30% or less. The third factor is your credit age. Now, this is how long you have used credit. It is the age of the oldest account, newest account, and average ages of all accounts on your credit files. Now, say you close an old account and the next oldest account is 10 years younger than the account that you closed. Your credit files may not show how long you have actually used credit overall. To have a good credit score requires at least one account on your credit file that is at least 6 months old. Of course, the older, the better. The fourth factor is account mix. Account mix is how many installment accounts and revolving accounts you have. Installment accounts are loans such as mortgages, car loans, or personal loans with a fixed monthly payment for a certain term, which is number of months or years. Revolving accounts are credit cards and lines of credit with an overall credit limit that you can charge against. Lenders want to see you can handle and are familiar with both type of accounts. So, a good mix of the two makes for a better credit score. The fifth factor is credit inquiries. Hard inquiries happen when a lender looks at your credit report because you have applied for credit. A hard inquiry affects your credit score, lowering it by 5 to 10 points for up to 2 years. When looking for a loan, it is normal to shop around to find the best rates. Now, depending on the scoring model used, if you do your loan shopping in 14 to 45 days span, the inquiries can be lumped into a single inquiry and affect your score less. While hard inquiries only make up 10% of your score. To maximize your score, try and minimize credit inquiries. So, is a credit score the only thing lenders look at? The score plays a large factor, but so does your full credit report, sometimes from one bureau, sometimes from others too. They may also look at your annual income and your debt to income ratio or overall debt. Your debt to income ratio is calculated by dividing the total recurring monthly debt you have by your gross monthly income to determine the percentage of debt you have compared to your income or available money. You want the percentage of your debt to income ratio to be on the lower end. Otherwise, a lender may look at a high number and immediately think you are unable to successfully make any more monthly payments and so consider you a higher credit risk. Credit card issuers and lenders may also look at how many reported delinquencies you have. How many hard inquiries were added to your credit file? Your overall credit card utilization rate, your annual income, and the health of your credit history. So, how to improve your credit score? Now, there is no shortcut or a quick fix. Develop a step by step approach towards remedying your credit worthiness. First, apply for a credit card against a fixed deposit. Actively transact your regular monthly expenses through this card. Ensure that you do not utilize more than 30% of the card limit and diligently repay before due date. Never roll over the balance to the next billing cycle. This will gradually build good credit history and exhibit improved score within 6 months. Alternatively, you can apply for a small cash loan up to rupees 1 lakh and repay it within 6 months and improve your score. And just for your information, a good CIBIL score is above 650 for a home loan or a loan against property, while it is above 700 for a personal loan, business loan, or a car loan. No score is required for a loan against gold since it is issued against collateral. Of course, any good CA will give you lots of valuable advice on this. Now, it is possible to get a loan even if you have a credit score of less than 750. But the approval process takes a longer time and is more difficult as your score decreases. Moreover, you might be given unattractive terms and conditions on your loan offer as you are viewed as a potentially risky customer. In addition to a longer loan approval process and more documentation, a low credit score translates to a higher interest rate on your loan, smaller loan amount, and shorter repayment period. It is advisable to ensure that you have a credit score of 750 before you apply for a loan in order to avoid the possibility of loan rejection or severe repayment terms. Sometimes a loan application can be rejected even with a good CIBIL score of 750. Now, this can be very disappointing and distressing for the applicant who thinks he has done everything he can to ensure good credit. Now, what are the reasons for this rejection? The first possible reason could be any settled or written off loans in the past. If you have any loan account that has not been paid according to the original terms of the loan, it serves as a warning signal to future lenders. This is an indication that you have not been fully financially responsible in the past, even if your recent history shows fully paid loans. Any such mark is a red flag for potential lenders as they see you at risk of repeating such behavior. The second reason could be if you have been a guarantor on a loan that was not repaid, then your credit score is affected. The third reason could be if you are marked as a defaulter by error. Sometimes, unfortunately, if you have moved into a house that was previously occupied by a defaulter, you might be listed as one simply because of the address match. Banks will reject your application outright on seeing that you are a past defaulter. The fourth reason could be your debt to income ratio. If you have many current loan obligations and are spending a high percentage of your monthly income on servicing your existing debt, you run the risk of rejection, even if you have a good record of making repayments. If your monthly debt obligations exceed a certain percentage of your income, lenders feel that you might not be able to take on further loan payments. For instance, if your monthly income is rupees 60,000 and you spend rupees 40,000 on making loan payments, you have little left to spend on personal expenses. Banks feel that you will be unable to afford further loan repayments. The fifth reason could be more unsecured debt. If you have a high percentage of unsecured debt, that is loans taken without collateral, like a personal loan, banks are unwilling to take a risk in lending to you. You should have a higher percentage of secured loans, like a home or auto loan, over unsecured loans. The sixth reason could be if you live in particular postal code. Strange though it seems, sometimes just living in a high risk locality can cause loan rejection, even if you have a good score. Through statistical data, banks have a list of neighborhoods that have a high incidence of default. If you happen to live in that area, you might be automatically rejected despite your good credit record. So, can you repair your credit rating? Credit repair involves rebuilding your credit health to a level where you become eligible for loans. People typically need credit repair services to help them improve their credit score and undo the damage done to the credit health because of faulty financial behavior in the past. In general, if you have a credit score of less than 750, it is advisable to seek professional help to improve your score and prevent rejection of your loan applications in the future. Any rejection further decreases your score as it implies that lenders have turned you down because of your poor credit history. Depending on the extent of your credit issues, it can take up to 6 to 8 months to reach a stage where you are loan eligible. Those with relatively minor issues can rebuild their credit in a much shorter time frame. A score in the 600 range will naturally take less time to improve than one in the 500 range. Rebuilding your credit is not an impossible task. Though there is no magic wand that will instantly fix all your credit issues, all it needs is a certain amount of commitment and perseverance to achieve your credit goal. Well, that's all from me in this video. This video is based on the information freely available on the internet. No originality is claimed for the same. The intention of this video is only to prepare candidates for answering examination questions on the subject. Do like and share this video and do subscribe to my channel now so that you do not miss out on my previous or future videos. And if you want to get in touch, I shall always be available at sumitacademy20@gmail.com. Till later then, cheerio.